Money, contrary to popular belief, is a wonderful thing. It solves the tremendous problems presented by the barter system, which requires people to find and negotiate mutually beneficial trades of some goods and services for other goods and services. The reason the barter system is problematic is because it suffers from the double coincidence of wants, where each party to a trade must have something the other party wants. A farmer who grows carrots but wants some cows needs to find some other farmer who raises cows but wants a bunch of carrots. Sacrifices have to be made, and value gets lost as the carrot farmer trades for some onions and then trades for some clothes and bread and uses that to get just one cow instead of two. It's just no good. Money solves this problem by acting as a medium of exchange. You can sell what you produce, whether that be carrots, cows, or video lessons on economics, in exchange for money, and then use that money to buy whatever it is you need or want. Money fulfills one of three important functions when it is accepted as payment for goods and services in this way. But there are two other functions that money serves in our society which help solve more than just the problems of the barter system. Money is a unit of account. It is how we measure and compare the value of goods and services. I can compare the height of two people by measuring them. The unit of height is feet and inches. If I say one person is 6 feet tall and another is 5 feet tall, you can understand their relative heights. I can also compare the value of two things, and the unit of value, or unit of account, is money. If I say one car costs $20,000 and another costs $25,000, you can understand their relative values. Money lets us compare the value of everything in the same way a ruler lets us compare the height of everything. This allows us to measure and compare the trade-offs we face and make prudent decisions. The third function of money is that it is a store of value. It's how we hold value over time. It's odd to think of it this way, but things would be a lot harder if we had to choose what we wanted to consume immediately after producing something. Money lets us produce something of value, sell it, and then hang on to the value until we decide what to spend it on. It's really this last function that this whole chapter is about. Before we get to that, though, we should mention two different monetary systems. One is called fiat money, and I have an example of fiat money right below it. The other is called commodity money, and I have an example of that one too. Can you spot the difference? It's not just that one has green on it and the other has blue. It's that one says $1 at the bottom and the other says $1 silver dollar at the bottom. Fiat money is currency backed by law. This is what the US has had since 1971, and certainly what you are most familiar with. The money that we use has no intrinsic value. It's just worthless pieces of paper that we have decided to imbue with value. The confidence we have in it is founded on its legal status. If you pull out $1, you will see printed on it, "This note is legal tender for all debts, private and public." In other words, the money has the backing of the government. Commodity money is currency backed by stuff. Throughout most of human history, that stuff has been gold or silver or some other type of precious metal. But if all the movies and television shows I've watched are to be believed, even things like cigarettes are used as commodity money in prisons. Anything will work so long as it has intrinsic value, meaning that it is a commodity people would want even if it wasn't being used as money. In the case of the dollar bill pictured, it could be turned in at a bank for a set quantity of silver. Fiat money and commodity money both have their advantages and disadvantages. Commodity money causes a lot of silly behavior and wasted resources, like trying to dig up rocks in the ground that people don't really want. It is also prone to a lot of fluctuation in value, as the value of the underlying commodity can change rapidly based on supply and demand. Fiat money doesn't have these problems, but it does have the problem of putting the government in charge of the amount of money in circulation, which can lead to significantly higher inflation. In some ways, understanding why almost every economy in the world has switched from some form of commodity money to fiat money over the last century is the big story of the next few chapters. Our modern monetary system finds its roots in the practices of medieval goldsmiths. These goldsmiths would take in gold ore and purify it, separating it from rock and forming it into transportable bars and coins, as well as making jewelry out of it. But gold is very heavy, incredibly heavy really, and people didn't really want to carry it around. So goldsmiths started to offer storage services. They built vaults that would be guarded, keeping people's gold safe for a small fee. Thus, banking was born. In return, the depositor would get a certificate for their deposit, which they could bring back to withdraw their gold at any time. It wasn't long before people started trading these certificates, signing them over to someone else as a form of payment. Eventually, the banks just started printing their own paper money, which could be brought back and exchanged for a fixed amount of gold. Just a few hundred years ago, most loans were privately arranged between the borrowers and the lender. People lent out their savings directly, seeking out profitable investment opportunities. But the goldsmiths turned bankers realized they could do this themselves. People would deposit their gold into the bank and would be given paper money in return, which they could use as a medium of exchange. But the banks then offered them the opportunity to save the cash they weren't using, which the bank would then turn around and lend out at interest. The bank would take a cut of that interest and pass some of it on to the depositor. Many people had no expertise at all in judging whether an investment was promising or not, and banks could specialize in that judgment. This opened the opportunity to grow your money with interest to many people who would never consider it otherwise. If you remember your solo model, investment is critical for an economy. And by increasing the savings, which could then be used to finance investment, banks are helping the entire economy grow. Modern banks continue to serve this function, and they use the money you deposit with them to make loans. But modern banks have evolved quite a bit from the olden days. For most of U.S. history, and especially from 1837 to 1864, the U.S. did not have a federalized banking system. Each individual state had their own rules about banks, and each bank was printing their own money. You can see here just a small sample of all the different types of currency issued by banks. Shopkeepers in these times got a giant catalog each year, like a phone book or a directory, which pictured all the different legal notes in circulation so they wouldn't get swindled by forgeries. During the Civil War, a National Banking Act created rules for chartering a national bank, each one of which was required to issue the same uniform currency. But all the state-chartered banks still operated as they did before, printing their own currency. Eventually, this would change with the creation of the Federal Reserve System.